All right, so the market's followed up 2 days in a row of extremely low volume and extremely low range with another day of low volume and low range. Not as extremely low, but still well below the average. So the markets are, and all three of these days have been slightly lower. So you can see how, I mean, that's a pretty darn bullish pattern whenever, you rally up. Not huge, but enough to keep the market trending and getting new all-time highs. And when we pull back, and this is a pretty significant pullback. I'll show you on one hand how significant it is. But to pull back and still have a lot of these indicators still showing very strong bullish patterns despite this 3-day decline. So I'll show you that as well and kind of what's driving this price action and what was the kind of the bigger move from an intermarket relationship standpoint. We always take a look at the sector rotation and the breadth. We'll take a look at that as well. And then our trade idea is a stock that's in the discretionary space, kind of that reopening space, this COVID reopening space, even though we're a couple of years beyond that. But still, it's reawakening and breaking out to a new bullish trend today. We'll talk about how to trade that. So let's go ahead and get started. Today is Tuesday, March the 26th, 2024. This is the market outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It opens up that tab. And hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. That's why we always ask. It's a big deal for us. So thank you to those who do this day in and day out. Our goal is to get to 100. We're right in that 60s, almost 70 level, so let's keep it up there. Thank you again. Those who don't like this, you can do it right now while you're watching with 1 or 2 really easy clicks. Let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. Big drop in the short-term sentiment. Not a big drop in the index itself. Again, only 14 points lower. Bigger range than what we've seen the last couple of days, but still well below the average, and that's a very low average, mind you. So it's not like we really broke down hard here. You have extremely bearish short-term sentiment. The momentum line's down, the near-term line's down. I mean, the last time we were down this much was at the very beginning of the year, and now we bounced right off of that with a strong move to extreme highs with the momentum line, and the near-term line followed suit, and we were back off to the races. We had a light pink shading there, at least. The intermediate line was below market sentiment. You had light pink shading. We don't have that now. So, now granted, on the day of the decline, we didn't yet. It came a couple days later. So now it's just a matter of how much more selling we get off of this. You would assume, again, based off of past precedent, that we'll bounce off of this. And that continues to be the expectation until we see something different, right? Until we see the pattern change. The intermediate line is still easily above market sentiment, though it is falling, but it's still above the 90th percentile too. So it's, which is extreme bullish level. So it's hardly like we're breaking down here in the least bit. So I wouldn't put too much emphasis on that right now. The Dow looks very similar. Again, a third straight extreme low for the momentum line, the near-term line following down there. But again, we're not even like light pink shading at all. See, we weren't even that bearish at the beginning of the year on the Dow. But that was the last time that the near-term line fell into the reversal zone. This is the first time that it's fallen to extreme lows. Again, since back over here when we were getting a bull tag by then. Again, we're also, remember, it's one thing to be coming off of a bearish near-term peak, but we actually, in which we had a couple of, but we're actually coming off a pretty bullish near-term peak. Now, it didn't last very long, but at least the near-term line got up to pretty high levels and didn't form this bearish peak, which is what you see. That's what happened on the Dow. The last time the Dow fell this low over here, we were coming off of a couple of bearish near-term peaks. So at the very least, we avoided that situation. So that's why it's like, okay, maybe, and again, we're mainly falling because of the small ranges. Again, about half the average here. These are very, very small ranges, and that's having an impact on such a bearish short-term sentiment. The NASDAQ 100 actually does not look nearly as bad, though the near-term line is down to the 20th percentile. The momentum line's not as extreme. It's oversold, but it's not as extremes. The intermediate line's in the upper reversal zone. Again, this is a bullish intermediate confirmation signal, a pretty darn good bullish intermediate confirmation signal. So the expectation is, and again, very low average on the range, the expectation is we'll bounce off. That's what this signal is. The intermediate line's crossed back above market sentiment, obviously back in the upper reversal zone as well. And then your Russell 2000 looks like the Dow and the S&P. The intermediate line is rising. The strong bullish posture, not quite in the reversal zone yet, but still rising. And you're down, though you're not down very much. Let me get rid of this here. You're not down anywhere close to the moving average, just like all the rest of the indexes. This one, you're a little bit closer, 1% above it. But still, you're pretty clearly above it. And then you can see the short-term sentiment looks very similar. Oversold on near-term line. Again, we got that low, too, at the beginning of the year. And again, we're not coming off of a bearish peak. We're coming off of a bullish peak, which is kind of similar to what we saw at the beginning of the year, which suggests that there's a good opportunity we can bounce up here. So very, very bearish short-term sentiment. Fortunately, it's mostly bearish because of how small the ranges have been here lately. The near-term lines followed suit, which is generally not too common on small ranges like this. Usually there is more of a decline that brings the near-term line down there. Even if it's not necessarily all the way to the moving average, at least it gets pretty darn close and gets you light pink shading. And we're not there yet on this. But, again, like we saw at the beginning of the year, we might be a couple of days away. But by the time we got the pink shading, we were already bouncing. Same thing over here. By the time we got the pink shading, we started to bounce. And we'll see if that ends up. Most likely will end up being the case this go around too. If you look at the long-term chart, again, you have the lower high point. Again, what we're watching for is the lower close, and we're nowhere near that, so we're still okay. The PPO is still rising, though at very, very high levels, and we're still converging on the size of the candle. So the candle's not very big, and it's still converging, but again, we haven't crossed yet. We haven't crossed below zero on this Hakunashi differential, or gotten the red arrow yet on the 10-week. We're not even close to getting the red arrow on the 10-week moving average. Of course, we don't have 3 green arrows anymore, so that ended. But again, it only got 1 red. Stochastics is well into the reversal zone there. Same thing on the Dow. The Nasdaq, the Q still has the green arrow on the MACD, so you still have a 4th day of green shading here. And of course, remember the Russell never did get the 3 green arrows, and you still don't. MACD is pretty close, but you still don't have it there. So not quite the strong bullish move. Even the Dow, which had strong momentum here, has really fallen off and is close to getting a red arrow on the. It's the red arrow on the stochastics that caused it there, whereas the red arrow on the S&P is what on the MACD is what caused it for the S&P 500. Still above moving averages. You're even still above the 8 days, so that's not an issue either. Again, it's just a very, very minor pullback. Same thing on IWM. Same thing on the Qs, same thing on the diamonds. I mean, you're sitting on the 8-day. You definitely haven't broken it. The MACD is still above its moving average. Hence the, now granted today it crossed slightly below it on the S&P. That's where the red arrow comes from. But on the other indexes still has the green arrows. Still well above the value. I mean, the value area, the 200-day moving average is at the value area. And you are extended away from the moving average. So we are quite the distance away from the value area here. When you look at some of these other oscillators, again, like the DMI, you're still very strongly bullish. Well above 30, you're still below 25 at least. It's like 25 is a new 20 now for the negative indicator, and you're at least below that here. Looking at the RSI and the CCI, you're still above 60 despite the pullback here. So that's still not a problem. The last time we had this much of a near-term decline, we had dropped below 60 but still stayed above 50. Right? So we're still okay. The CCI is still in the upper half of its chart as well. Looking at the Ichimoku cloud, very strong trend. We haven't lost it. We're still above the green line, still positive, still above the cloud. So, I mean, really nothing to complain about here. We are not above the upper Keltner channel anymore. We are still slightly in the upper quartile of the bandwidth. So even that's still bullish. So, I mean, again, if you can have this extreme of a near-term decline and still have everything strongly bullish, then that is like the picture-perfect scenario right there. Now, granted, it's not always going to be that way, but that kind of goes to show that there's not as many buyers anymore because the market's just so extremely bullish. But it's also, there's no sellers coming on. I mean, we might say, well, look at the selling, but the reality is that selling is nothing. Again, we still don't have a 2% decline here. We don't even have a 1% decline on this pullback. Now, we've had 1% declines before, just not a 2% decline, right? So, as recently we had a 1% decline there. So, but even this, again, the last time we had as bearish moves as we did, we got as close to 2% as we could get without crossing that threshold. And again, we haven't even crossed 0.75% with this one, despite how extreme the near-term levels are. Looking at the, obviously we didn't get a new 4-week high point. We did start off with a higher high, ended up with a lower low by the time it was all said and done. Though, you see we're up a little bit in the after hours. We're moving back towards the value area, moving back towards the midpoint of the chart here. The green line's moving down because of the lack of the new high point, and you can see the low has moved up to here. That's why your red line has jumped up, is because your low has moved up to this low point. And again, it will be there for a couple more days, or at least through the middle of next week, and then we really, so the size of the bandwidth is really, really small, and it will just get smaller unless we break out. But we are definitely setting up for a squeeze play. It's just a matter of which direction, right? That's the only issue is, are we going to squeeze back? The bands are back outside the Keltner channels, but the bandwidth has been just getting smaller and smaller and smaller. So we are setting up for a squeeze play, and even on the long-term chart, we're still pretty wide on the bandwidth, and still pretty wide too on the Keltner channels, just starting to come down on the blue line. So we're just kind of starting some disinflation on the bullish momentum here on the longer-term view. Let's look at the VIX. Not surprising to see the VIX not really moving. It moved up at the end of the day, back above 13. We were below 13 for most of the day. We're still well below 90%. The VVIX was down at 75 today. It ended up being a little bit higher, but still is an extreme low point. So the VVIX was threatening this low point here earlier in the day today when we hadn't dropped so much. So we are still extremely low in volatility, very, very low, and setting up for a bounce, right? So we're setting up for the squeeze play. We're setting up for a bounce in volatility. When those things come to fruition, it could be next week, it could be next month, right? We don't know, because when you have a parabolic move and such a strong trend like we have, it can go as long as the trend, the momentum of the trend can carry it as long. Obviously, we're at records, and without the 2% decline, we're at records in terms of, or at least historical numbers in terms of like 100-day returns. And so when you're at these kind of strong numbers, unless you have a significant catalyst, just running out of buyers isn't enough to start the consolidation. As you can see, it can be enough to start a convergence, but the market can still rise during a convergence, as we've been seeing for the last so many weeks. All right, now let's take a look at what's driving this price action. You can see the decline really over just the last few days and just how minimal it is relative to like the 3-month return. And really, we're not quite 3 months here, but we're getting pretty close for the year-to-date return to be 3 months. Real estate and bonds are down the most so far this year, whereas the S&P and the Qs are up pretty significantly. Even with, like I said before, a strong dollar, commodity prices. Now, commodity prices fell pretty good today. If we were to take a look at just today alone here, you'll see that commodities were down significantly. Again, 0.75% is not that big, but in context of a day where nothing really moved at all, it ended up being down quite a bit. Yields were down too, as TLT was down. Interesting that the drop that we had at the end of the day coincided with really not very much of a move in commodities, not very much of a move in bonds, and not very much of a move in the dollar. And yet a pretty significant drop in real estate, which has pretty much been behaving like a tech stock, essentially. Dropping with the Qs, and then you can see IWM, high yield bonds also dropping, falling below. But again, if you take a look here at high yield relative to like the the equivalent of the Treasury complex that's got the similar duration to high yield. You can see, I mean, it was down today, and it's down the last few days, last 4 days, quite a bit. If I were to take a look at like a rate of change here, it's not a lot, but it's one of your bigger declines that we've seen in a while, at least. You can see the 4-day rate of change down here at the bottom. Again, one of your bigger drops. We had a couple of big drops here earlier, over here and over here, and right now we're, technically just a smidgen below the 17-day. The RSI is still, you can see this positively correlated with the S&P. The ratio is, we're still above 50 on the RSI. The PPO is still above 0. We've got a strong long-term PPO as well. The CCI is still in the upper half of its chart. The DMI still shows a positive. So it's not like we're breaking down, but again, you can see, and if I were to do the equivalent for the investment grade with that 7 to 10 year bond, which is that TLT, you can see it dropped a little bit more. Again, not as strongly positively correlated, but still positively correlated with the S&P. And you're right at 50. The MACD is still above 0. We've been falling on that long term. The CCI is barely above 0 there. We have a negative crossover on the DMI. So you kind of see how, again, not as big of a drop on the last 4 days compared to what we've seen before, but still a drop nonetheless. So getting a little bit of risk off, right? Whatever ratios you like to use. This is traditionally correlated, not always, as you can see, and it's been converging. Another correlation that's been commonly used for risk appetite is copper versus gold. Generally correlated positively with the S&P, has not been correlated because we've been on a downward trend for the bulk of 2023 and now this year, and we're back down again, right? So this generally coincides with weakness in the markets, at least in risk appetite, when copper is underperforming to such a large degree. And then you can go into like growth stocks relative to value stocks. Traditionally has a strong positive correlation, has one in a pretty decent drop today, though still above moving averages and well above the 200. But you get the idea that the risk appetite appears to be peaking, no matter what kind of relationship you look at. When you look at the number of stocks above the 50-day moving average, we're doing pretty well early in the day, but we dropped just a smidgen below the moving average here on the number of stocks above the 50-day moving average. And then you can see also dropping right to the moving average on the number of stocks above the 200-day. As a result, the ratio of the 50 to 200-day jumped easily back above 1, not quite above its moving average, but you can see moving higher. So breadth dropped today. Like, that was a pretty good drop. This, you can see the number of new highs and new lows dropped pretty sharply, well below its moving average. Still not below 0, but well below its moving average. The skew, which had jumped up so much, is still above 150. So it's like 4 days in a row now we've been above 150. The breadth here, if you look at the breadth on the indicators that we look at here, like the McClellan oscillator, minus 11, still not below that minus 35 yet, which is kind of what you need to see. If we're going to change the trend and really go and start to correct, we kind of need to hit that minus 35 or more level. That signals that things are bearish enough to start correcting. And obviously we're not there, despite the divergence we're seeing on the summation index down at the bottom. And of course, the money flow index also impacted by today's weakness. Here we go. By today's weakness there, you can see the drop, and still above 50, but below 60 and dropping now on the money flow index down at the bottom. Again, dropping below 50, especially getting below 40 is when things really turn bearish. But the first sign of weakness is at least dropping below 50. And we're kind of marching a little bit there. So again, it doesn't necessarily show that things are weak now. It just shows that the bullish move is weak. And so still bullish, still in convergence mode, but not necessarily in a directional move yet to the downside. Just still a convergence period, which generally speaking, convergence periods will continue to move in the direction of the trend. In this case, the upward. Will move upward in the direction of the existing bullish trend that we have. Let's take a look at how the sectors performed here today. We'll just zoom in on just today alone. So we'll go to March 26th. And you'll see here that, again, we were doing okay. XLY was doing well. The financials, healthcare, and communication services. So, odd mixture, but it's still, doing okay here. But then everything dropped. XLK dropped. Utilities really getting beat, despite the fact that yields did not really move up very much. Again, you look at the three main asset classes that we follow. The 10-year yield actually fell today. When you look at the dollar index, it rose. There's a little bit of a rise, but not very significant of a move. And then when you look at commodities, remember, really fell. Like, that's a pretty sharp move, a bigger down move that we saw. And it appears like there might be on a little bit of an intermediate decline right now, or excuse me, a near-term decline. So very short-term move to the downside in commodities. So those two. So, again, that's generally pretty bullish for the markets when you're in that kind of environment, and bullish for these sectors. But you can see utilities did not take advantage of that weakness in yields with that big drop there, and technology as well underperforming. When you look at the Magnificent Seven, you can see like NVIDIA, which is probably the biggest reason why we were bearish today, dropping over 2.5%. Meta dropping, Broadcom dropping. Those have all been kind of moving in tandem. Amazon dropping as well. Apple getting another oversold cluster today. Microsoft dropping towards. So everything that has been green is kind of dropping towards the moving average. Everything below the moving average is kind of actually moving up today towards the moving average. Google kind of the exception. The few exceptions to that trend. Netflix as well also continuing slightly higher there. All right, as we saw, MGM, or consumer discretionary, was pretty strong today. The discretionary was pretty strong, and one of the stocks in that space kind of broke out was MGM. MGM with a very strong, really past couple of weeks, but today breaking through above last week's high. The momentum line jumping up to extreme highs. The near-term line jumping back above the intermediate line. The intermediate line had already been above market sentiment. We had a little bit of a dip there to bearish territory, but a bounce up off this short-term decline pullback. If you take a look at the weekly chart for MGM, you can see we bounced up there again, the week's not over, but 2 more days. But we are right now are closing above last week's high point. That's a pretty strong candle. Can be used to signal the beginning of a bullish move. We broke above the value area today, the 1-year value area, with a strong MACD, stochastics well in the reversal zone. The moving average is all rising. The only one that really still is below and falling is that 30-day, but it is below the 50. So more of a continued move to the upside would bring that 30 up above the 50. And we can continue this move up. Looking at the DMI, you can obviously see a bullish pattern there, above 30 on the positive indicator, well below 20 on the negative. The ADX is almost above 20 itself, looking like it's beginning a new trending move. The RSI and the CCI also are at strong bullish levels, up above 70 on the RSI, and well above the minus 150 or a positive 100 on the CCI. Looking at the Ichimoku cloud, you can see we are up. If I can get to the box, there we go. We are up above the cloud. All right, so we had been inside the cloud for a good chunk of time here. By the time it turns pink, as long as we're above it, then we have a good chance of the trend. And that's kind of where we're at. The rate of change is positive. We have a new weak trend developing there. And another sign of a new trend developing is breaking out of the Bollinger Bands. And in this case, the Keltner channel as well. So breaking out of both of them, with the bands themselves breaking outside of the Keltner channel, with an increasing bandwidth coming off of a pretty significant low point. So we had kind of broken out a week ago, and we've broken out. The week ago we did not break above the Keltner channel. This one did. So we have a chance that we can really get going to the upside. So what I did was, instead of going too aggressive, I decided to go to the April expiration. Buy the at-the-money strike, go to the mid-30s for my short contract. So this is what it ends up looking like. Let's just go to the single symbol, and we'll go to the market outlook category. So you can see there's my potential reward. You can see it's easily inside the 1 standard deviation move. It's not that big of a reward. So think of it as kind of like a bull put spread, but a little bit more directional, right? So I'm risking half of what I normally do for bull put spread and gaining twice as much as what I normally try to get on a bull put spread. So I like that setup there for kind of a less aggressive but still directional trade on MGM, and see if we can continue to ride this this breakout move a little bit higher. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow me and like me on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all next time.